Hello, my friends. This is Paul Drockton, and we're going to talk about stock market basics. To learn more about stocks and other investments, go to my website, moneyteachers.org. Now, there's two basic types of stock, common stock and preferred stock. Common stock, also called equities, because it's ownership in the company, and common stock usually has voting rights. Preferred stock, which is actually a corporate debt whereby the investor gets paid based on an actual percentage rate, has no ownership or voting rights. Common stock is ownership. So common stockholders vote on members of the company's board of directors. It's the common stockholders that elect the board of directors. It's the board of directors that selects the chairman of the board. And it's the board of directors that hires the company's chief executive officer. The chief executive officer hires his management team, with or without board approval. And the concept is that the board and the company will always act in the best interests of the company's shareholders to maximize corporate profits and increase dividends or shareholder value. So when you look at the corporation and we look at common stock, what you're really looking at is you're looking at a republic, form of government for business. There's two types of stocks. Growth stocks don't pay a dividend and are expected to invest back into the company's growth. Growth stocks are expected to appreciate in value as the company grows, whereas income stocks pay a quarterly dividend as long as the company is profitable. Dividends are a percentage of total company profits divided by the number of shares of stock outstanding. So the question is whether or not the company is going to reinvest profits back into the company, or if the company is going to go ahead and pay those profits out as dividends to the stockholders. Now, the primary determination of value is the price-earnings ratio, or PE ratio, for publicly traded stocks. So what we're looking at is the price of the stock and comparing it to earnings. And this will tell you how many years it will take to get your original investment back. Price is what the share of stock is currently selling at. Earnings are a combination of dividends, if they're paid, and market appreciation. The lower the PE ratio, the better the value is to the investor. These are the historical PE ratios of the S&P 500. Now understand that the S&P 500 represents 75 cents of every dollar invested in the stock market. So really it's the most important index. So when you look at the PE ratios and you take a look at the corrections of the past, the mass corrections, the market always tries to correct the value. Here you can see that the market corrected down to a PE ratio of 5-1, which means that it took 5 years for the investor to get the money back out of the stock. The same thing took place again, as you can see here, and then here. So reality is that the market always tries to correct the value. Now, today, the price per earnings ratio is 24. So that means 24 years to get back the initial investment in the share of stock. And that's the average PE of all the companies listed in the S&P 500. Now, alpha and beta can also help you value a stock. Beta measures how a stock moves, whether that's positive or negative, in relationship to a broader group of stocks in a stock market index. In other words, it measures that stock's volatility compared to the broader index or market. A stock that moves with the market has a beta of 1, and it's considered an average risk. A stock that is less volatile, meaning that the value doesn't fluctuate as much as the index or the market, is going to have a value less than 1. And a stock that is more volatile, meaning there's a lot more price change, is going to have a greater value than 1. So low beta traditionally means less risk, but also lower returns. High beta means greater risk with a chance for higher returns. Remember, these are just a way for you to compare different stocks against each other, determine whether or not one has more risk, more volatility than another. The other thing that you can look at is alpha. And alpha lets you know if there are better returns out there. Alpha is that particular stock's investment return measured against a broader return of the market or index. So if you have an alpha of 6, that means that particular stock has 6% better return than the index. So if it's an S&P 500 stock with an alpha of 6, then that means that it outperforms the S&P 500 by 6%. An alpha of 0 means it has the same return as the broader index. An alpha that's negative, for example, -5, means it has less of a return than the broader market. Again, this is just a way for you to compare one stock with a larger index, so you can make a decision whether or not you're getting the best return. Now, I'm going to explain a whole lot more about investing in the stock market, mutual funds, variable products. Just go to my website, moneyteachers.org. When you get there, make sure that you subscribe to my newsletter. And all of the online courses that are normally password protected will be yours for free. This is Paul Drockton, America's #1 financial expert, and my website, moneyteachers.org.